presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for May 14th, 2021. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. You can get the daily edition Market Wrap simply by clicking on the link below and downloading the app, and you'll get the entire hour every day where we have some great guests and my views on a daily basis. I'm going to talk about the recovery, where we are now. We'll talk about the markets in detail and some of the technical analysis. We did have a lot of volatility this week. First 3 days, we saw inflation coming back and everybody said, oh my God. You heard it about 2 weeks ago that I talked about the inflation numbers for the next couple of months are going to be hotter than expected because we hotter than even what people are looking for. We're comparing these inflation numbers to last year's inflation numbers, which were taken when the economy was dead. So we are recovering in the economy. The inflation numbers are coming back. The big word that the Fed is talking about is transitory. That means, will this inflation go up and come right back down? Or will it go up and stay there? No one knows the answer to that at this point, and that will determine the future of the market in the next year and a half. Between now and the end of the year, we have plenty of stimulus that is going to stimulate the market. So let's take a recovery and take a look at where we are. COVID is just about gone now. We are getting the vaccines out to as many people as they can. Now we are also looking at that they're going to take the mask mandate away. And what that means is anybody who doesn't have COVID will either get COVID or get the vaccine, as I mentioned. So we should get to herd immunity in the next couple of months. And that should give us a total reopening here in the United States. China has already been open for a year. The United States is catching up now. Then the next in line is Europe, that really dropped the ball as far as getting the vaccines out to people. The UK and the US did a lot better. But I believe in the next couple of months, Europe will be catching up also, and we will pass the baton on the recovery economy over to Europe. And then over the next 6 months or so, I expect that baton to be passed around, going to the emerging markets. So we are going to see this recovery ricochet around the world, and this is just the beginning phases of this economic recovery that we're seeing here in the United States. If you look at the number of excess debts, they are way down now compared to even there's no excess debts now. So COVID is something that we're going to read about, hopefully in history books. I believe it will be a yearly phenomenon. We'll need to have some kind of booster shots, just like the flu shot on a yearly basis. Hopefully we can take pills and they'll come up with some kind of one pill that we can take. You can look at the comfort, you're looking at some of the vaccinated and unvaccinated, how many people, vaccinated people are feeling much more comfortable about going out compared to, and that is natural. You're going to see a lot more people. According to TripAdvisor 2021 Summer Travel Index, compared to the first week of January, hotel searches are up 65%. You heard me last year talk about how I thought the economy would come roaring back. We've got $2 trillion, $3 trillion, $4 trillion sitting in checking accounts that have not been spent. The question is, will we spend all of it? Part of it? I think it's going to be a part of it, depending on how the economy does. If the economy starts to get a little bit shaky, stock market starts to go down, real estate market stops going up, people stop spending very quickly. But right now, everybody is just in the first phase of getting out, and they want to make up for lost time. They want to go on those vacations. Looking at the economy, you look at the recovery tracker, we look at jobless claims in 2019 level. This is where we were. Well, we are still up 121%, but a lot better off. This is where we were pre-COVID. This is where we are now at 3.7 million. We're looking at ASA staffing. We're just about where we were pre-COVID. You're looking at weekly retail sales. We're doing pretty good here. You're looking at box office. Well, we're still not going to the theaters. It'll take a while for us to really feel comfortable going into large crowded areas where there is a lot of people. I mean, restaurants, you still can social distance, but going into theaters, concerts, and things like those, I think it'll be a while before we feel real traffic is back up higher than where it was in pre-COVID. Steel production has come, it's only about 8% lower than it was. Hotel occupancy down about 12% from pre-COVID. So we are catching up. I think in the next couple of months, as we open, we're going to catch up. But we had a very turbulent week on Wall Street as we saw consumer prices rose to a 13-year high in April. Inflation, folks, is going to be coming in the next 2 or 3 months. The question is, will it come and stay at this high level, or will it drop back down? No one knows the answer to that, and that is what is going to determine the future. If the Fed has said that they believe it's transitory, goes up, comes back down. That's why they're not raising interest rates now. They're going to let the economy run hotter. They want to see inflation running on a consistent basis, and if it does not come down, then the Fed has fallen behind inflation, and then they will have to play catch up. By that I mean they'll have to raise interest rates faster than anticipated, and that is, if you're going at 80 miles an hour in a car without a seatbelt, you slam on the brakes. Not good consequences. But if you're going 80 miles an hour and you tap on the brakes and gradually slow the car down, that has a good outcome. And that's what the Fed is doing. They want a soft landing in this particular economy. I will have to wait and see if the Fed is be able to do that. Surge in raw material prices could reduce profits and cause Federal Reserve to tighten economic policy. That is what the market was scared of, and that's why when we saw inflation numbers come out on Tuesday and Wednesday, the CPI and PPI, the market came down dramatically. But then everybody said, wait a minute, this might be transitory. We came down and then we came back up. We still ended lower for the week, but it was not as bad as it could have been. I believe when you look at the charts, there were support areas that I talked about. That's where the market exactly went down to and bounced off. I think we are going to go back and forth, and I'll take a look at the charts and explain that. When you're looking at loan supply, there's a shortage of loans there. You look at the interest rates, they're way down. If you look at the spreads between high yield and treasuries, it is a lot lower. Looking at the charts, I talked about the S&P coming down to support the 50-day moving average, which was right around, somewhere right around 40.84 or 64 is where it is today. On Wednesday, it was around 40.50. Market came down, made a low of, I believe, 40.56. Popped right back up, closing today at 41.73. So we came way up from there, right back up to the 20-day. 42.35 was the target that I had put out in, February? I said we could get to 42.35. Well, last week we had a high of 42.38. That's where we dropped down from. Right now we're in this gap. We've got to fill this gap, and if we do, then we get above 42.35. The target becomes 4,400 for the S&P. The question is, will we go straight up? I think we are going to bounce around here for a while, go back and forth. We need a little bit more consolidation, but I believe this week's low that we came and tested it should be it. But we'll have to wait and see. That's my opinion, the way I am looking at the charts. The weekly charts point to a higher. This is the third wave extension that we're looking at, which points to 44.75. Again, the 4,400 area. Jeremy Siegel came out and said we could get another 10 to 20% in the stock market between now and the end of the year. I don't know if he's correct or not, but if you're looking at, we're up 11% right now. If you get another 10%, that'll be a 20% year this year in the market. A tremendous year in the market. If we get even 11, 12%, 15% is a great return as long as you are participating in it. You do not get pushed out by the emotional ups and downs and the volatility of the market. That's why I emphasize, make sure you have the right asset allocation where you can handle the volatilities. If you're chasing and trying to become rich overnight and buying the go-go stuff, you were go gone this past weekend. This past week, when the market went down 8 or 9%, the Nasdaq, you were down 30 or 40%. At that point, becomes very difficult to come back. That's why having the right volatility, the right allocations, so you can handle the ups and downs in the market. It's being in the market. It's time in the market, not timing the market. That is the important thing. that you have to is staying with the market over a period of time. This is the Nasdaq daily chart. We dropped below the 50-day. We're still below the 50-day, which is 13,539 today. We closed at 13,429. So I think, again, Nasdaq got a little bit more work to do, but if we can get above 13.5, then we go to 13.7, and then 14.750 has been the long-term target. Support is around 14.5, also the 200-day moving average. Again, I talked about 13.5 previously, where we went down to on the weekly charts. We bounced off on the Nasdaq weeklies. Each one of these lines is 1 week of trading. I still feel that we are okay with the Nasdaq, but we need some stability and start to move here. Gold, 200-day moving average. Inflation should have really sparked a rally in gold. Everybody buys gold when they're worried about inflation. But the problem with gold is right now, whenever we talk about inflation in the economy, the interest rates go up. Interest rates go up, the dollar goes up. When they go up, gold goes down. That's what kept gold in check. And you've heard me for the last 20 years on the daily edition of Market Wrap, or 30 years now, talk about whenever you get good news in a market and it does not go up, watch out for that market. We had tremendous good news in gold. It should have gone up. We'll see if it can get above the 200-day, which is 1854. But if inflation does become sticky, then gold could be headed higher. So far, it has held the double bottom. Support now is going to be right around 1700 or 1800, which is the 20-day moving average. And then we're looking at support around 1756 or so, which is the 50-day moving average. Emerging markets, I think they have gone back and forth a little bit in this fourth wave going back. We're below the 50-day now, which is around 73.51. I think we need a little bit more time getting more vaccine out first to Europe, then to emerging markets. So we could buy a little bit more time. Russell small cap, again, it's been stuck in this 2100. I've talked about that 2100 to 2350 area. It's been going sideways for a number of months. We need to get above and break out above. If we can break above 2350, then we're headed to 2500. That's the small cap index. I don't know if we're ready yet. Small cap is the reopening trade. Small cap is small businesses that were the most impacted by the COVID pandemic. So that means I believe that we are getting ready for a breakout, but we're still below the 50-day, which is 2246. We closed today at 2224. So we need a little bit more work in this index. The small cap weeklies, again, sitting at the 20-week moving average and just gone sideways, as I mentioned, for a number of weeks. We need to break out of this channel, and if we do, we could head up to 24.25. Make sure, folks, do me a favor to make sure we continue doing these updates on a weekly basis. Click on the thumbs up button, subscribe button, and the little bell. That way, we get a lot more hits or whatever. We get more updates, and we can get these updates to you. Whenever I do an update, you will be notified. Those are my views. That is the way I'm looking at the markets this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.